Hello, everyone, and welcome back to ABG Investor Days. My name is Adrian Gilani, and I'm an equity analyst here at ABG, and I will be moderating our upcoming presentation, which will be given by Mr. Erik Danemar, CFO at Ferronordic. He will give a roughly 15 to 20-minute presentation, and then the remainder of the time we will do some Q&A. So with that being said, Erik, please go ahead.
Thank you very much, Adrian. I'll try to give you a rounded picture of who we are and what we do, and then you can ask a bit more specific questions at the Q&A session. So Ferronordic was founded in 2010. At that time, we were operating mainly in Russia. We were the only distributor of Volvo construction equipment in Russia at the time. We then added further brands to the portfolio, including Sandvik, Detta, and Swedish Rottne forestry equipment. In 2022, when the conflict broke out, we sold our Russian business at the end of that year, in December of 2022, and left Russia. In 3 years before then, in 2019, we had also expanded into Kazakhstan with Volvo construction equipment, and also Mecalac makes backhoe loaders, French, German brand. In 2020, we also expanded into Germany, where we don't do construction equipment. Mind you, we do trucks, Volvo and Renault trucks, again for Volvo. And not so long ago, in November 2023, we expanded to the United States again with our partner Volvo Construction Equipment. We acquired a dealer there. I'll get into a little bit more detail on that on this slide here. So again, last of November last year, we acquired Rudd Equipment Company. We paid $10 million for 2 properties and 95 million for 100% of the equity or shares in Rudd. We funded 60 million of that with our own cash, and the residual 45 with a bank loan from Nordea Bank. We also had a working capital facility with Nordea. During the full year of 2023, on preliminary estimates, still they report US GAAP, so that's our conversion. They had revenue of about 258 million and operating profit of 21 million. So based on those preliminary estimates for 2023, we paid about 5 times earnings before tax, or 7.3 enterprise value to operating profit. And we paid about $14.5 million of goodwill based on the PPA that was concluded after the acquisition, and that has been audited by KPMG. And moved Ferronordic after the sale of the Russian business from a big net cash position to a net debt position, but with a big operation in the US. A few metrics on again our profile. So when we started in 2010, we were 160 people. Now above 800. That's for Q1 this year. Revenue not like for like there. So you want to maybe take the 24 revenue times 4. So about 4 times where we were, given that that's just 1 quarter you see there. Outlets 7 times more than we had in the beginning with our new profile. And you see here also what our revenue split looks like, or revenue mix. So equipment and trucks around 60%, aftermarket sales say 30%, and other revenue, mainly rental business, being around 10, here 6 in this quarter. You will also see on your lower point here the geographical distribution, so 60% US in the first quarter. It was a strong quarter in the US, and it was a weak quarter in Germany and Kazakhstan, especially Kazakhstan actually. So probably 55, something like that, and 40 to Germany or around there. something on the profile. Aftermarket focus, so this ties back to the previous slide, but it's a very important one. You can see there the revenue share coming from aftermarket, that is service and parts, in the US and in Germany. This is really the core of our business. It's the most important part. Our CEO slapped me on the finger. If I ever say sales and service company, it should always be service and sales company. Service comes first to make sure that our customers' productivity and uptime is maximum all the time. That's when they buy the machines, and that's what feeds the virtuous circle that provides us with activity to do. So really the service part first, so that our customers have maximum productivity. I tend to say that we sell small factories, even more so I think in construction equipment than maybe in trucks, but in both areas. Small factories that the customers use to be productive, to produce or move earth or what they do. And these small factories demand service and they consume spare parts. And we need to be there to be sure that they operate all the time. Also, I mean, if you look at the economics of the business, the aftermarket has bigger margins than the original sales and typically other revenue as well. That comes back in these slides, actually. So these are our strategic objectives, how we want to create value for our shareholders. Leadership in the market for construction equipment. This isn't necessarily to be the biggest. It's hard to be in Germany when we're up against Mercedes AMN, which has 30 and 25% of the market. But we want to be the best to our customers and always offer the best service. Aftermarket absorption of one. This is important, especially if you work in a more cyclical business or volatile markets. What this means is that the gross margin from the aftermarket, so again, service and parts, should cover the fixed cost of the business. So even if we don't sell a single new piece of equipment, we should still cover on a break-even level. We're not there in Germany and not on an overall basis for the business either. We were historically when we still had Russia, which was a very big business, but this is an objective for us to get to. Expansion into related business areas. So this is really leveraging the platform. We put infrastructure in place. How can we do more than we do without conflicting with our current partners? So we don't want to bring in any competitive equipment to our current partners, but we want to expand and complement so we can offer a bigger product range to our customers and also use our platform more efficiently. Expansion of contracting services. This was again something we did a lot of in the past. This is where customers, instead of buying a piece of equipment, typically a heavy excavator and an articulated hauler, they pay us per cubic meter. We own the equipment, we hire the operator, we run all the service and the fuel logistics, and we are very confident that this is, at the very least, part of the mobility market of the future. Possibly be a very big part of it, but the fact that it will be there, we're quite sure. So we want to have a space in that industry going forward as well and see great potential to leverage that. I think any player needs leading a digital service and sales platform, but we work in a industry with predictive maintenance potential. We can should service machines and trucks before they break down to maximize productivity, and that's what this is about, integrating these signal systems with our sales platforms, and geographic expansion, which we of course have engaged in, as you've seen, going into Kazakhstan and Germany and now US, and something that we want to build on where it makes sense, where we can add value and it makes sense to our platform. Won't dwell on this. Our product portfolio, again, Volvo Construction Equipment is the biggest part now, and then followed by Volvo and Renault Trucks. And then you have a lot of other brands, Hitachi in the US, Link-Belt in the US, Sandvik, an important partner as well, and Mechelek Sandvik in Kazakhstan as well. Really just looking at the footprint, so you get a sense on this slide here. The head office in our US business is in Louisville, and we are in 9 states, all or parts of them. US is the second biggest market after China for construction equipment, and market in our area was around 4,000 machines in 2022. In Germany, also, not only we would argue, strategically located in Germany in the center of Europe's biggest market for trucks, but also in the center of Europe when tractor trucks go through from Portugal to Poland or in other directions. So a good piece of the market there. Kazakhstan, a very big to the in terms of geography market, bigger than people maybe realize, and also now acquiring an interesting hub role in the region with a lot of Turkish and Chinese involvement in that market. Very briefly on the first quarter, just to where we got to, we published last Thursday. We called the quarter a strong start or a good start in the US. Indeed, we had a very good start in the US, both in terms of top line and profitability. We had 86% revenue growth, and that's really not organic, but driven by the contribution from the US. Similarly, operating profit of 21, also, as we'll see, driven by the US. For those of you that may have seen the net income number, that is very much driven by a big foreign exchange gain. Now with net assets in US dollars and to some extent, or actually a big extent euro, but the euro moved less in this quarter, we will see these volatility from foreign exchange swings. And then again, net debt, as I mentioned, we had 378 net cash in the third quarter of last year, and now we have a net debt position of 1.5, mainly, of course, as a result of that acquisition. To some extent, also an increase in working capital that we want to work down through this year. I think I have 3 minutes. Yeah, so again, looking just a little bit more at the detail there, you can see, as I mentioned, big revenue growth, but it's really driven by that contribution from the US. Otherwise, Germany organically on its own was down in terms of revenue, and it was mostly driven by new sales. Aftermarket sales, which is very important, was up 9% year on year, but sales of new trucks declined significantly, partly driven by a weaker macroeconomy and market in Germany. CA, which is Central Asia, i.e. Kazakhstan at the moment, very weak quarter in the first. There we had, sadly, a number of natural disasters, both floodings and earthquakes, so that partly disrupted the market in Kazakhstan in the first quarter. Operating profit 60 in the US, minus 12 in Germany. Germany, we're not happy with that. We have announced in the fourth quarter of last year, we started a cost efficiency program, which we will work through in this quarter as well. We started then in the fourth quarter and will work through to the end of the second quarter of this year. And then we hope to have achieved the same savings we're aiming for. And again, Kazakhstan, too low. It's the nature of our business that commissions go down when we sell less, so you have some cushioning on the cost side of sales costs mainly. Net income, I mentioned, driven by foreign exchange. Cash flow positive on an operational level. Significant capex, and that may you may ask what that is. It's mainly in the rental fleet in the US, and rental in the US is a sales channel. They put machines into the rental fleet, rent them, but they also sell these out continuously to customers. Not a way we do things in Europe or in Kazakhstan, but it's an important sales channel there, important to be competitive. So that's what that reflects. And then net debt, I mentioned, still strong balance sheet in terms of equity to total assets at 33%, and book equity of 1.7, which makes it a price to book of something like half almost. Yeah. So with that, I think I've just made it.
Perfect. That leaves us with around 10 minutes for Q&A, so I'll start right off. And I'll start off with your newest and now largest segment in the US. When you announced this acquisition in November, you described it as a first step of expanding into the US market, implying that there is future expansion to be expected. So can you just elaborate a bit on your plans in the more mid to long term in the US?
Yes, very cautiously, I can do that. No, I think, I mean, as I mentioned, it is part of our core strategy to look for opportunities for geographical expansion. It makes sense for a dealer of our size to expand geographically per se, because it's a way to utilize the group costs and the overhead you have more efficiently. It's a way to build a broader dialogue against your suppliers, your OEMs, as we do, and we will continue to look for that. That said, I think we're also aware that we want to digest what we have just acquired. We have a program in Germany to improve that business. We want to show that we can get that right, and that's taking some of our management attention. So a combination, I think, of digesting that, getting Germany in place, stabilizing, and then looking for new opportunities. With the caveat said that sometimes opportunities appear, and we want to be nimble and be able to react to them as well, somewhat opportunistically. But again, the bias would be first we digest this and settle it.
And we've seen you expand in different ways. We've seen you acquire large companies, but we've also seen you sort of with greenfield or brownfield expansions in new workshops. Can you just sort of elaborate what the pros and cons are of those, and what if there's one that's perhaps more attractive for the US market?
I think, I mean, the US is quite a mature market, in contrast to our background where we came from. I mean, I showed you we had 6 workshops when we started in 2010, and at the peak we actually had 112. So really a broad rollout, and then we rolled it back somewhat to find an optimal level. I think in the US again, the market is fairly well penetrated. The competitors are there. Volvo is there with different representatives in some of the states. Volvo still operates on its own, and when I say Volvo here, I mean the construction equipment part, which is where we went in the US. So it's probably acquisitions is more likely there as a start. And then there is a question, I mean, even in our area now, we can speak about geographic expansion within the US, we can, meaning different states, we can speak in the world, meaning looking at different regions or a country's markets, but also within our area. And within our area, is there room for better network coverage? To some extent, probably. So then I'm speaking about more rolling out further workshops in our area. So there is also some room for that. When we build ourselves, I mean, here it's I think build replacement cost arguments that we're looking at. What is the best economics to achieve the best results, and really trying to weigh in all the factors of having a state-of-the-art modern workshop, like built one in Hanover in Germany, from the scratch with solar panels and all the new electric charging stations, or if we can find a bargain purchase of something that is used and we can really convert it into something we need. So opportunistic there as well.
And to sort of understand the market dynamics in the US, obviously there's been a lot of talk about the big infrastructure projects from the government. It's also prevalent sort of extractionary industries there as well. Yeah. What really drives construction equipment demand, or what has driven it and what will drive it forward?
Yeah, so it's a good question. I think, I mean, you probably have several levels of drivers. On the one hand, you have the beta, I guess you could call it, the market growth, the GDP, which is a fairly strong correlation with construction sector, et cetera, which drives what we're doing. On another hand, you have commodity prices, which can also drive. We felt that in our history a lot, copper prices went up, and copper projects in gold. We've worked a lot with gold companies. Gold prices go up, and the DCF models of the gold companies allow a lot more. They open new projects and they need new equipment for that. And then you have a third level, which is government investment programs. infrastructure, road building, bridge building, railroad, all this takes a lot of construction equipment. Whereas the normal construction, other construction would more sit in the GDP bracket here. So that's all, if you will, sort of exogenous to us. We try to capitalize on it to the best extent we can, but it's external driven. And then we have what's internal to us, which is where we, of course, again, by providing, really starting with the service, providing the best parts availability, machines can never stand still. That's the rule. That's when our customers lose productivity and they lose money, actually. We can increase our market share. And then in that very same market, even whether it's moving or not, we can still grow our sales of both equipment and aftermarket. And maybe just to add here also, I mean, I say aftermarket is everything, but it is. But we need the population to service. So a population is very important to build for future business. You put that park of machines or park of factories, as I called it, out in the market, and then you can service it in the years going forward.
And switching subjects a bit, but historically, when you were in Russia, you started to ramp up this new revenue channel of contracting services, and you've sort of, it was very lucrative at the time, and you've hinted that this might make a comeback in one of your newer geographies. Can you take some time to explain that model and how we should think about that in terms of a comeback in the future? Yeah.
Absolutely. I mean, so the basic of the model is, if we take the old core model, a customer bought a piece of equipment, and then they hired operators, and they called us when they wanted our service or parts. And then it's really a scale towards what we call contracting services. You have something called cold rent, where they rent a piece of equipment, but they have their own operator. They have something called hot rent, which is where they rent the equipment and the operator from us. So we have that. And then they have various service packages, which you add onto it. So more and more integration with us. And then you have furthest, if in my allegory here at least, to the right, contracting services, where we, again, own the machine. We do all the servicing, the parts, the service maintenance work that needs to be done, and we operate the machine, and the customers pay us only per cubic meter. This moves the asset to our balance sheet, which does imply different risk. We try to manage that by signing 3-year contracts at least with customers for this, and basically this equipment should at least be refurbished after 3 years, because for these kind of works that they do in contract services, they should work 22 hours per day. Very high utilization, so they're actually worn down after 3 years. Now, I think one of the very, strong reasons that it aligns interests in a different way with customers. We're kept very tight by competition to be, as I said, as efficient as we can with parts and service. But at the end of the day, in the old model, if we speak abstractly about it, the more a machine breaks down, the more sort of reserve and parts you need to put on it. Again, very kept tight by competition and wanting the need to progress our position and always improve. But in this model, the interests are aligned in such that we really want as little interruption to these machines as possible. They pay per cubic meter, and we just want to get them those cubic meters delivered at the very least costs for everybody. And that will push down the cost there in a way that I think is, again, a part of the future. And I think our OEM partners are also quite excited about that business model.
I understand. I think we have time for one final question, and we haven't really talked about Germany yet, so I'll ask a question. There are a clearly weaker market for trucks in Germany right now, and I'm not going to ask you to predict when the market will get better, but how are you adapting to the current situations, and what's your action plan until sort of we see a recovery in the German truck market?
Yeah. That's a good question. Well, as you say, the market is weak. We've seen a big turn. We have gone from a post-COVID situation of supply constraints, which was a situation that caused a lot of problems for I think, a lot of players in the industry, including us. We had to order 12-month ahead trucks to get something at all during those supply constraints. And then we have a whiplash effect where they get delivered, and now we find find ourselves instead in a situation where the market is somewhat, it is demand constrained. So now the supply is there, and you have supply of new trucks, used trucks, and rental trucks, and demand is soft. So this is happening in the market in Germany. We are taking actions, as we announced in our reports, by adapting our organization. We built up in last year for a bigger market to come, both in terms of new sales and aftermarket, and we have to adapt that organization to make it more resilient. So it goes back in a way to what I said about this absorption rate, to be able to carry ourselves in Germany better. We're not going to get to full absorption in the short term. That will take longer term, but get to a much stronger situation than there. So we launched a program by which we've shrunk the number of sales areas, so concentrated those. So it's really a way of working horizontally in the organization, but also vertically, very hard on the top overhead G&A lines, basically, to cut costs there and become more efficient. All of it without, we try hard not to have any negative impact on that very important aftermarket.
I understand. And with that being said, we've used up our time. So I'd like to thank you for your presentation and for answering my questions. And also thank you to everyone listening in.